AT&T employees, and welcome. Thank you so much for spending a little bit of your afternoon with us today. I'm Sam, and I'll be moderating this presentation, so I'll be behind the scenes. If you have any questions throughout the presentation, there is a Q&A box on the screen. You can ask those questions. It is 100% anonymous, and I'll make sure to field those to one of our AT&T focused financial advisors to reach out to you after the presentation has ended. Today we're going to be speaking with Tyson Mavar. He's going to be giving you some really important AT&T pension updates, and I apologize in advance. He will not have time today to answer any of your questions after the presentation has ended. We do like to respect your time and make these presentations as short but informative as possible. But like I said, please ask away in the Q&A box, and I'll make sure one of our AT&T focused financial advisors can reach out to you afterward. Lastly, please be reminded that we are not affiliated nor endorsed whatsoever by AT&T. We are not AT&T. We are a completely independent group of financial advisors here, so keep that in mind as you're listening along today. And without further ado, now we're going to jump right into it with Tyson Mavar.
Good afternoon, folks. Thank you for attending our webinar series today. My name is Tyson Mavar. I'm a financial advisor and retirement specialist for the Retirement Group. Today, we're going to be talking about the AT&T pension, ways that you can increase your benefits by just understanding your pension formulas and some of the issues related to the AT&T pension a bit better. So we'll talk about not only the pension options, lump sum versus annuity, we're going to talk about service pension eligibility and how critical that is to understand and certainly know when you hit your Mod 75 or your SPE, service pension eligibility. And we're also going to talk about the interest rates that affect the lump sum for those of you that are considering taking your AT&T pension as a lump sum. So first, let's talk about what are the old plans. If you're a craft employee, non-management or union employee, this plan has stayed the same for a very long time. And it's based on your pension band, which is a function of your pay from AT&T. The higher your pension band, the higher your pension payout. There is still age penalties for craft employees if you retire prior to age 55 and don't have 30 years of service. But if you reach age 55 or get 30 years of service, you're not going to have any age penalty. So that's helpful to know. Now, there's a lot of different management plans. There's a lot of different AT&T management employee plans based on the region of the country you started your career with. The company you hired on with, SBC, Ameritech, PacBell, Bell South, Legacy T. There's a number of different heritage companies, all of which have slightly different rules on how your pension works. Now, this cash balance plan was created in 1997 for managers, and this was one of the newer types of plan that was a substitute for the old plan that managers were on. They also called it the grandfathered plan because if you were already working at AT&T in 1997, you got this opening balance. And then they continued to credit your pension based on interest credits and salary credits going forward. Now, this plan was frozen in 2002, so that it was only receiving interest credits. It's no longer receiving salary credits. But we bring this up, even though this is a very small portion of most employees' pension calculation. This is what equates to the partial lump sum that you all have as an option, at least folks that are on the non-bargain program. Now, the CAM plan, a much better pension payout, still getting credited with salary credits. This is a traditional defined benefit plan. And for most of you, that's going to be your highest benefiting formula. It's creating your actual pension payout, whether you take it as a lump sum or an annuity. So it's not a supplement to the cash balance plan. It's either or, but that cash balance is still calculated. And you can see it the first thing you log in on the Net Benefits website to your pension plan. It'll show you the cash balance plan, which for most of you is going to be a much smaller number than your actual pension payout. And so this is why it's helpful to work with an AT&T retirement specialist to make sure you're planning correctly, you're pulling the right figures off of the Net Benefits website. So you can understand how much you're going to have. You can pick a better retirement date, and then ultimately maximize your benefit by getting the right timing and also help you make a good decision on whether to take the lump sum versus the annuity option. Now, Mod 75 is something that's also important. So service pension eligibility, if you get 30 years of service, you're service pension eligible regardless of your age. If you don't have 30 years of service, there's three other ways to get service pension eligibility, which are going to entitle you to a larger pension payout. It used to also entitle you to retiree medical, but that has been stripped away for management employees as recently as just a couple of years ago. So if you retire as a manager, you're not going to get the retiree medical anymore, but you can potentially get a better pension payout by hitting one of these milestones. Now, the three ways to reach service pension eligibility other than 30 years of service is by being at least 50 years old with at least 25 years of service, or at least 55 years old with at least 20 years of service, or at least 65 years old with at least 10 years of service. You'll notice that all three of those add up to 75, but that does not mean that if your age and years of service add up to 75 that you necessarily are service pension eligible. For example, you could be 53 with 22 years of service, and you'll notice that age and service combination do not meet any of these age and service criteria. So you've got to meet one of these four criteria. 30 years, of course, gets you there, but a combination of age and service that falls under one of these three modified rule of 75 combinations will get you a higher pension payout. And if you're not sure when you hit that, let us know. We'll help you figure out when the exact day that you hit this is, and can start planning for ideally a retirement that's after that mod 75 date. Now, it's also interesting for some to learn that your life expectancy also plays into your lump sum calculation. For example, the younger you are, the more lump sum you're going to get, all else held equal. So you may have some age penalties. If you're a manager, you're not yet age 55, it's possible you have some age penalties that are going to reduce your payout, which, by the way, you can age out of if you leave the company and just wait to take your pension. That's news to a lot of people to understand that you can defer the election of your pension, and it could make sense. I will tell you, when we go through this exercise with new clients, figuring out what the growth rate of their pension is, deferring the election or leaving it in the plan after retirement, compared to what the growth rate could be in even a safe investment like a CD or money market, most people will choose to take their pension out pretty quickly. But depending on your risk tolerance, your need for income after you leave AT&T, whether or not you decide to go back to work somewhere else, all of these are going to play into what's the optimal timing of the commencement of your pension, but it might not be right after you retire, as it turns out. But all else held equal, if you're somebody with the same years of service, same salary, all your circumstances are the same as your coworker, but you're a couple years younger than them, chances are your lump sum is going to be higher than theirs because your life expectancy is longer. For example, if you are 60 years old compared to somebody who's 55 years old, they are going to have a higher lump sum payout than you, everything else held equal. They're also going to have, the younger individual is going to have a more sensitive lump sum relative to interest rate changes. For example, a 60-year-old might see a 10% drop in their lump sum when interest rates go up by 1%. The 55-year-old might see a 12 or 13% reduction in their lump sum for a 1% increase to interest rates. And the same thing works on the flip side. If interest rates fall, the younger individual is going to see a larger increase to their lump sum than somebody that's older than them with all of the same other characteristics of their pension formula. Now, interest rates, in addition to life expectancy, will affect your pension payout. Now, every pension is a little bit different in how they observe the interest rates. Both Legacy T and Legacy S managers have this same inverse relationship with interest rates and their lump sum, wherein if interest rates go up, your lump sum is going to go down. On the other hand, anybody who's on a cash balance plan, this would include many mobility pension plan recipients, Bell South. It's a variety of different regions and heritage companies that have a cash balance plan that do not have this relationship. So make sure you talk with one of our specialists so you understand which pension you're on and how that pension works with interest rate, how it changes with interest rate changes. But for most people, interest rate increases are going to result in a decrease to your lump sum. I'll zoom into the most recent interest rates. The way AT&T observes this is they're going to use November of the prior year interest rates, which are corporate bond interest rates, released by the IRS, also known as the PPA segment rates. You can see there's three of them: first segment, second segment, and third segment, which correspond to short, intermediate, and long-term corporate bond interest rates. Now, I will tell you that the second segment rate by far carries the most weight in the calculation for your lump sum. So, for example, you could see the first and second segment rate going down, but if the first and third segment rate going down, but if the second segment rate is going up, chances are the net impact is that you're going to be losing money on your lump sum. So the IRS publishes these rates monthly. Of course, it's the November rate that applies for AT&T retirees. And if you retire and take your pension in 2025, you'll be getting the 2024 interest rates, which, as it turned out, were lower than the prior year. So we saw some increases to lump sums last year. But if you look, you could see that the second and third segment rate are higher since last November. The first segment rate happens to be a little bit lower, but my guess is most of you, if you run a lump sum calculation for retiring now compared to retiring in January, and you plug in these rates, assuming these rates stay the same through November, you're going to see a reduction in your lump sum value. Depending on how rates fluctuate throughout the rest of the year, it may be a catalyst for some of you to leave payroll prior to the end of the year. And it's different whether you're Legacy T or you're on the non-bargain program, for example. You have different rules on when your benefit commencement day can be. Legacy S, or folks that are on the non-bargain program, you can commence your pension the day after you retire. So feasibly, you could retire December 30th, commence your benefit on December 31st, and keep the 2025 interest rates, which, as it appears, is going to be more favorable unless things change throughout the year. Legacy T, not the case. You have to retire by November 30th because your only available commencement dates are the first of any month following your retirement. You also cannot have a benefit commencement date beyond age 65. So if you retire at or after age 65, you're going to be subject to an immediate benefit commencement, and you cannot defer the election of your pension for potentially purposes of getting more money as a result of falling interest rates. So all these play a pretty big role in determining the optimal time to retire, the optimal time to commence your benefit, which may not be right after you retire, and ultimately whether you should take a lump sum or an annuity, which, for many of you, the lump sum will not be appropriate. And we'll give you our honest opinion on that. Our fiduciary responsibility is to tell you what we think makes sense based on the information you tell us about your circumstances. And we have enjoyed a pretty good reputation among the AT&T community for over 30 years. So we want to make sure that we're giving you good advice so that A, you might consider doing some business with us. And more importantly, B, you might refer us to some of your coworkers who also may consider doing some business with us. So we talked about some of the different formulas, the cash balance, the CAM, and let's talk about that cash balance. We told you that that formula was frozen in 2025 so that you're no longer getting salary credit. So it's not growing much anymore. It's only growing by interest credits, which are based off the 30-year treasury, which does happen to be a little bit higher than it was about 3-4 years ago. However, most of you, all this is used for is for calculating your partial lump sum option that comes with a residual annuity. For most people, I rarely see people taking that anymore. That was popular years ago when managers did not have a full lump sum option, because it was the only option you had to take even a portion of your pension as a lump sum. Now managers have a full lump sum option, so I don't see many people taking this partial lump sum with residual annuity. Cash balance account, as a result, is not as relevant as it once was. Now, the career average minimum formula, this is for most of you that are on the non-bargain program of the AT&T PBP, which you'll see when you log into Net Benefits and click on your pension. So management employees that were hired after June of 2001, you had to wait 3 years to become eligible for this, and your credits are no longer as lucrative as they were prior to the changes that AT&T made on the formula. You can see what those changes were here in January of 2022. They changed from a credit of 1.6% of your final average pay, or average pension compensation, as they call it. Now all of your years of service beyond 2022 are only getting that 1% credit. So the pension's still growing for most of you, but it's not growing as quickly as it was prior to 2022. As a result of this, we've seen a lot of people leave AT&T. Some by choice, some by force through surplus announcements, some by force because they were forced to move to a different state, Dallas and Atlanta, where a lot of people were being forced to move to. And for many people, this was a big benefit because you could take your pension, you can work another career, maybe have an entirely new pension if you are able to work another 5 or 10 years, depending on your new company, contribute to a different 401k, and invest that lump sum. For many of you, not needing to create income right away because presumably you had a new job, 6 months, maybe a year after you left AT&T. And there may be more lucrative benefits outside of AT&T. So this is why it's always a good idea to be looking at your options, understanding your benefits and what you can do with those after you leave, and also understanding what's available out there, both from a compensation standpoint as well as a retirement benefit standpoint. Now, there are some age penalties for managers on the CAM plan. If you retire without the modified rule of 75 being met, your age penalties are going to be very severe. For example, you may only walk away with 35% of your pension, even if you were only 1 year away from reaching mod 75. That would be a 65% penalty on your pension. Work one more year and you get 100%. If you reach mod 75, it's still possible you can have age penalties, and that would be somebody who is at least 50 years old with at least 25 years of service. You got the mod 75, but you're still going to have 5 years of age penalties at a rate of 6% per year, unless you have 30 years of service. If you have 30 years of service, your age penalties get cut in half into 3% per year. So maybe some reasons to continue working at the company as a result of hitting some of these milestones, because your pension is growing a lot quicker in those early years, whereas the growth rate starts to slow down once you reach some of these milestones, and you're not being compensated as much from a pension perspective to continue working at the company. And so here you'll see that severe penalty. We actually have one of our clients' sister retired from AT&T, 54 years old, had over 20 years of service, but was not mod 75. And she got that 65% discount. She only walked away with, for example, if your pension was $1 million, you'd only be walking away with $350,000 on your lump sum. Work one more year in this example, and you increase your retirement benefit by $650,000 in this case. So well worth understanding some of these milestones and how they play a role into the optimal timing of your retirement. Now, of course, the lump sum has always been popular for a number of reasons: inflation hedge, death benefit flexibility, more tax efficiency in terms of controlling the distribution strategy, flexibility with how you invest the funds. A number of reasons people take the lump sum, but the annuity options have their merits and need to be considered. Single life annuity is the highest payout, but it's good for only one lifetime, only you, the retiree of AT&T. No death benefit once you pass. Joint survivor annuity, there's a variety of different forms of this that allow you to toggle how much money your joint annuitant gets. It might be your spouse, it might not be. But the more money you give your joint annuitant after your lifetime, the less money you will receive during your lifetime, hopefully during your lifetime together. And choosing this option is going to typically be a function of other benefits that your spouse might have: Social Security, pension, 401k, the age discrepancy between you two, both of your propensity to work after you leave AT&T. All these play a role in what's likely going to be the optimal option, whether to take a lump sum versus annuity, as well as which joint annuity to take, assuming that you go that route. Like I mentioned earlier, partial lump sum with residual annuity is not that popular. Typically, it's going to be full lump sum or full annuity. And what a lot of people will do, many clients that we work with are interested in the benefits of a lifetime income payment. But some of them, maybe they don't like the fact that there's no cash refund value. In other words, if you both pass away, or if just you pass away in the case of the single life annuity, company keeps all your money. No death benefits to family. And there's a number of other features available from private annuities, an inflation possibility for inflation increases. Maybe you just don't want to take the full annuity, maybe you only need half of the income offered by the annuity. So you could take the full lump sum and put half of that money into your own private annuity that may have features that are more attractive or more specific to the benefits and needs of your family. So that's pretty common, but it's not likely usually that we'll be able to find an insurance company that will dollar for dollar beat the immediate income offered by the AT&T annuity. So it's good to shop around always. Only takes us a few minutes to shop some of the different insurance carriers, see what they're offering, single life income, joint life income, what it costs to have cash refund options so that you're not giving up the principal and the death benefit. But the lump sum has been pretty attractive, even in these higher interest rate environments where lump sum has gone down in the last 3 years. We still see a lot of folks that we're working with, clients and prospective clients, taking the lump sum for a number of different reasons. One of those being, what we saw just a couple years ago. AT&T sold off the pension liabilities, at least a portion. I think it was close to 25% of pension liabilities, affecting about 96,000 AT&T retirees. They sold the liabilities off to an insurance company called Athene. So now these annuitants, with no control of their own, no say in the matter, are now getting their pension paychecks from Athene rather than from AT&T. This did not affect those that qualified for retiree coverage, didn't affect their health insurance, just affects the source of their retirement income, their pension income. Now, this has happened to a lot of companies. This happened to Verizon. They sold off some pension liabilities to Prudential years ago, and many other companies in different industries. This is one thing that is outside of your control if you take the annuity from AT&T, for better or worse. But one thing that we don't like about this as advisors is that this guarantee, if you will, that you had from AT&T to have income for the rest of your life, it's no longer guaranteed by the PBGC, Pension Benefit Guarantee Corporation. There is additional insurance that the insurance companies have to have, and each insurance company is regulated by the different states. But the event that the insurance company is insolvent, it's possible you could see reductions to your pension. It's still possible you could see reductions to your pension even if AT&T maintains the liabilities and there is PBGC insurance. But the point here that a lot of people we talk to is concerned about is you don't really have control over who's paying your pension and the risk associated with that after you leave the company if you take the annuity. If you take the lump sum, you have a little bit more control of how that money is invested, what companies that go to. Maybe you keep it at Fidelity, maybe you move it to Vanguard or Schwab. Our company happens to use both Fidelity and Schwab as custodians if you decide to work with us. We don't care who you pick. A lot of our AT&T clients gotten familiar with Fidelity, so they just keep their money there and have us manage it at Fidelity. And you may decide that you want a portion of your money guaranteed, whether it's a principal guarantee, income guarantee, death benefit associated with an annuity. It might make sense to have a portion of your either pension or 401k going to one of these arrangements that you have some additional insurances built in that you might not get from things like stocks, bonds, and a typical managed portfolio for a retirement account. Just a couple things that we didn't necessarily like. No shade specifically on Athene, at least right now, but in 2020, they posted a $1.1 billion loss in Q1. The Federal Reserve Board cited them as being potentially vulnerable to stock market shocks. And pension funds taken over by private insurers like Athene may carry additional inherent investment risk that you don't have when your company is paying your pension that is insured by PBGC. And a lot of employees rely on these pensions and face certain uncertainties about the future if you don't take the lump sum, if you take the annuity from your company. So we just need to be aware of this. Some people, it's not a big deal. There's certainly risk to taking the lump sum. We want to educate you about as well when we talk about the options and the merits to both. But they both certainly have their risks. The other one that we didn't talk about there is the inflation risk. And that's something I've seen a lot of people taking the lump sum because we saw such high inflation a couple of years ago. The AT&T pension does not have cost of living increases. So the higher inflation goes, the more risk you have of running out of money because your purchasing power on your pension is declining at a faster rate. And that's something we just can't control or predict over the future, is what inflation rates will be. Now, what we have seen is that 74% of Americans over the age of 50 don't have a written plan for their retirement. And this is mind boggling to us as advisors, especially since a variety of companies, including our own, will do this for you on a complimentary basis. The benefit of doing this is to make sure you're on track, you're saving enough, make sure you're saving efficiently, pre-tax versus Roth contributions versus after-tax contributions, making sure you're allocated correctly based on your time horizon to retirement and your propensity for risk in that account. Make sure that you've started to think about your benefit options in advance of leaving the company. As many of you know, a lot of people at AT&T don't pick their retirement date. In many cases, the company will pick your off-payroll date for you. And in my experience, most people have not done enough retirement planning leading up to this unknown off payroll date. So doing it now will at least give you the comfort of knowing that you've thought about some of these things in advance of what is typically a stressful time for people, whether they get a surplus letter or something happens in your life that requires you to leave the company. Maybe you need to move, or there's a health concern for you or a family member. The point is, put the plan together ahead of time and revisit it periodically so that you're ready to make good financial decisions when the time comes for you to leave AT&T, whatever the reason might be that you're doing so. Get a second opinion, even if you already have an advisory firm, or maybe you're just doing everything on your own. We're happy to do this for you on a complimentary basis. We're confident at the very least you'll probably recommend our services or our company to some of your coworkers. And best case scenario, we'll poke some holes in your plan. We identify some improvements to be made. And maybe you do a test run of our services by having us manage a small portion of your 401k before you retire to truly confirm it was a good fit to work with us. It was a good relationship, and you were getting a lot out of the relationship for what you were paying for in that. A number of our clients go with us because they know we have hundreds of AT&T clients. We're happy to furnish references, by the way, if you'd like to talk to some of our clients about how we've done. We've been doing this for over 30 years. We've seen every mistake in the book. We also have a higher level of accountability, we believe, than an advisory firm that doesn't have a large number of their clients coming from AT&T, because if we mess up, it's going to severely impact our business. If somebody else messes up, it might just lose your business, but might not care about the reputational damage that happens within the AT&T community. We care a lot about this, folks. We want to make sure we give you good advice, even if you don't become a client, but we think we have a pretty compelling story on why you might consider working with us. If you'd like to ask us some questions, have us run that cash flow analysis, review your 401k, talk to us about anything at all, you can email us at info@theretirementgroup.com. Call us at 800-900-5867. You can even take a picture of this QR code to get a link to our AT&T focused advisors calendars, so you can talk to myself or one of my colleagues about your situation. We'll be honest with you about what we think you should be considering. We'll bring some things up that we think that you might want to consider doing before retirement. And then we can also talk to you if you're interested about what it's going to take to work with us, if you'd like to open an account and actually hire us as your advisory firm, even if it's just for a small amount of money to do a test run before you retire. Well, we'll talk you through that when we meet with you, whether it's in person, on the phone, or even in a web meeting. So with that, we'll wrap it up for our conversation today. Thank you so much for spending some time with us today, folks. Everybody have a good rest of your week. We hope to talk to you all very soon.